This is TrepWire Week in Review for week ending February 24th, 2023. I'm Martha Kocher with Trep, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, geopolitical tensions with Russia and China fanned the flames of uncertainty. Fed minutes underscored the central bank's commitment to tackling inflation, and in economic data, a raft of results to digest. U.S. business activity rebounded in February. Revised GDP was weaker than expected for Q4. Housing data reflected a still struggling market, and earnings gave us some insight into consumer spending. Manus, all of this is ahead of inflation data, the PCE number that will be released Friday, and investors are concerned about what it means for the Fed.
My biggest concern that we saw this week about the economic numbers probably came with the Walmart earnings. The thing that scared me the most about Walmart was the fact that their forward-looking predictions for consumer strength, for sales and so forth, was pretty lackluster, right? They gave us a sense of the consumer is tapped out, right? That it's going to be hard for them to dig in, and they expect sales to reflect that in future quarters. So on the top line for these companies, you have pressure. I think at the other side of their announcement was that remark where they said they're going to spend an extra $1 billion this year on wages. So they are getting squeezed in three ways right now, right? The consumer is tapped out and sales are expected to be flat over the next couple of quarters, disappointing. We know that their cost of doing business is up across the board, whether it's from their borrowing costs, their cost of goods and services and so forth. And then lastly, they have to compete even harder to get employees to come to work with higher wages. We are coming off the end of an earnings season that was similarly lackluster. It was the smallest beat for earnings in something like 15 or 20 years. Earning estimates were compressed to begin with, and the amount by which we surpassed them was negligible. So all of this is pointing to an environment where companies are not making a lot of money, yet there's no evidence at this point that the economy is slowing down. The Feds came out this week and said a 50 basis point rate hike could be in play, right? It could be necessary. Hot jobs, hot retail sales. To your point a few moments ago, historically low first-time jobless claims. All of these point to a combination that could leave us in a stagflation environment, and that's probably the worst of all worlds. Yes, I should correct myself. The weak forward-looking guidance was Walmart. The higher than expected wages, along with weak guidance, was Home Depot. It was Home Depot with a double whammy, not Walmart.
If we remember a couple weeks ago, Walmart did announce wage increases, I think up to, was it $17, if I remember correctly? So yeah, I think your point is valid.
Yeah, they're all of these retailers are facing the same struggles. At Walmart, it was not just wages, but they also were offering additional expanded tuition reimbursement assistance and other things to stay competitive in the marketplace. And so, Manus, it's a really interesting time right now. The geopolitical tensions, it's like we can all feel them being ratcheted up. I know, Putin had several comments this week on Russia-China relations. I think at one point was saying, the two countries had reached new milestones. Russia pulled out of the New START nuclear arms reduction treaty with the U.S. At this point, it doesn't appear that they've withdrawn from the pact completely, but they're basically just saying we're not going to allow inspections and we're not going to allow the U.S. to know what's going on here at the same level that they had in the past. Coupled with the China discussions makes for some very interesting dynamics in the marketplace. President Biden was in the Ukraine this week. There's a lot of other things going on in the world. We've had a lot of stuff domestically with train derailments, chemical plants catching fire, a lot of other stuff. It's been a very interesting couple of weeks here in the U.S. And so if you look at the economic data, though, you hit on this, inflation adjusted gross domestic product increased, at 2.7% annualized rate during the last period, the fourth quarter. That was previously reported at 2.9. So it was actually a reduction from what was reported previously. You mentioned the Fed minutes. It's interesting. James Bullard is the one, is kind of front running this 50 basis point hike, which we've all, talked about for several months now that he thinks rates have to be significantly higher than where they are to tame inflation and control the economy. So I think 25 basis points is probably still what I would assume to happen, but you can't rule out the 50 basis point. A couple of other nuggets this week, on the housing front, mortgage interest rates were at a last couple of months high. 30-year fixed rate mortgage was 6.5% as of Thursday, and that was according to Freddie Mac. And if you look at what the Mortgage Bankers Association is saying, they said mortgage applications for refinances and home purchases declined significantly, and purchase activities decreased to the lowest level since 1995. So even, worse than the 2008 time period. So it'll be very interesting to see, if those rates persist. We had a little bit of a reprieve over the last 90 days, and it seemed like activity had picked up a little bit, but with rates increasing, it doesn't bode well for the housing market. As far as the Home Depot and Walmart, it's interesting. If we look at earnings, holistically, if you look at data from February 17th, S&P earnings scorecard, 81% of those constituents that have reported results, only 67.4% reported earnings above analyst expectations, which is well below the prior fourth quarter average of 75.5%. So it kind of speaks to what you were talking about with some of the downward pressure and people not having the earnings that they've had. And you mentioned, this being the lowest in some time. It's actually the lowest since fourth quarter of 2015. And if you go into some of the specific sectors, information technology had the highest earnings beat rate at about 81.5%, while the real estate companies were at 54.5%. So not good news for the real estate specific sectors on the earnings front.
Yeah, I mean, peeling back the onion a little bit, on the geopolitical front, incredibly terrifying, right? You have this potential alliance brewing of Russia and China hinting that it's already giving Russia strategic assistance, and it may increase that to military supplies, stockpiles, et cetera. You have Europe saying if China were to do that, that would be a red line, which I wish people would stop using that term red line, because unless you're really going to enforce a red line, it just becomes less and less meaningful over time. And then you have, what will be the U.S. response to all this. The takeaway for that, for our listeners, is there's almost no way to hedge against that, right? If things ratchet up, if hot becomes hotter, there is no hedge against that, right? You just know that people will get concerned and the economy will take a hiccup from that. If anything, I would say it's probably inflationary, because the U.S. is probably be forced to spending more on military and so forth. But there is no way around that, right? You are the tail there, right? You have no control over that. On the other side of the coin, on the commercial real estate side and the broader U.S. economic side, what we're seeing right now, I think, can only be seen as headwinds for the commercial real estate segment. I've probably mentioned this 10 times over the last year, but when corporate earnings disappoint, people lay off people. They use less space. They don't expand offices. They contract. They consolidate. They don't open new stores as frequently. They may not be as patient with existing stores that are weak performers. So, if you're a landlord right now, whether it's office or retail, I think all of this comes back to a stagflation environment is the last thing you want to see, where corporate earnings are squeezed from the bottom up because of input costs or wages, and they're squeezed from the top down because sales aren't what they could be because the consumer is tapped out. And if that happens, I think, I don't think it's apocalyptic, but I do think it's a headwind. And I think that it makes it harder for offices and retail landlords to compete and survive and prosper.
And to close out some of the retail comments, obviously, Walmart talked a little bit about the fact that the consumer is under stress. A lot of their revenues were driven by grocery sales, which are lower margin sales, which doesn't bode well for earnings next week, which will include Macy's, Nordstrom, Kohl's. And a lot of those are more discretionary. And obviously, we can talk a little bit about Dillard's while we're on that topic.
Yeah, Dillard shares were down 9.2% Tuesday after the retailer reported fourth quarter sales that missed expectations. They also announced a couple of store closures. I think they announced they were going to have 3 additional store closures, and that's in Florida, Nebraska, and Arizona. They are going to open a new store in South Dakota by the spring of 2024. And what we've seen, over the last couple of quarters, they reported inventories that had increased. So Dillard's was about 4% on the increase of inventory as compared to the prior year. And you mentioned Macy's, Nordstrom, and Kohl's, which report next week, Martha. I think the outlook at this point would have to be, negative going into those expected earnings results. They're probably suffering even more so than some of these other that we've talked about, Home Depot, Walmart, et cetera.
The retail, I echo your thoughts, Lonnie. I think that next week could be quite bumpy for retailers out there. Two thoughts on that. The first thought is for our Trepwire readers and so forth, we do track these store closings every single day. We're looking for them really around the clock all the time. So if you haven't seen much from us in way of store closings, the good news is that none of these Dillard store closings touch CMBS. And thus far, only one of the Walmart closings has touched CMBS, one in Portland, which we wrote about earlier today. But we are staying on top of that. Correct me if I'm wrong, Lonnie, but I think of Dillard's as Southwest, Southeast, Midwest, Upper Midwest, not heavily positioned in the Northeast, right? And we've talked about for the last year how economically the Southeast, the Southwest have done pretty well, right? The economies there have done okay. So if Dillard's is struggling, it'll be interesting to see if this means that those with more Northeastern presences, more Upper Midwest presences like a Macy's, do they do even worse? We'll find out in a few days, but I would have thought Dillard's would have been the surprise to the upside, not the downside, given their geographic footprint.
Yeah, I agree with you. I think they're probably a pretty good bellwether. And in this case, to your point, probably indicate we're going to see some even more negative news next week. As we're saying, retail is facing challenges and we have some data to back that up here. On the other side of the equation, it was reported this week that for the first time since 2016, major U.S. retailers opened more stores than they closed in 2022. And that was according to a recent report from Coresight Research. So they stated that retailers opened 5,103 stores last year and closed 2,603. They're actually putting out a projected number for 2023 that's similar to the 2022 number, where they're expecting new store opens to be around 5,200 and store closures to be around 2,800. So while all of the reporting and everything maybe paints a negative picture around retail from an earnings perspective, some of these more niche retailers or maybe more geographically diverse or maybe geographically concentrated where they have some upside, it seems like they've been able to capture that in the form of new store openings. So, I think there is some silver lining here, depending on how you look at the marketplace.
I stand by my remark from many months ago, which is I think that the era of huge store closing announcements is over, right? We've seen a couple this year and they were bankruptcy driven or near bankruptcy driven with Bed Bath & Beyond and Party City and Tuesday Morning. But if you go back to 2017, it was hundreds of stores per week, week after week, death by 1,000 cuts for these retailers. I stand by the position that if you didn't get rid of your store from 2017 to 2020, when we were going through the early stages of the retail apocalypse, and you lived with that store through 2022, chances are you love that store and you believe in it and you're going to keep it. And I stand by that.
So before we go into the property sector news, I did want to cover a couple of the tech companies, Intel and NVIDIA, which talk about a tale of two different companies where one got a lot of Wall Street adulation and the other one was cause for a lot of concern.
I think you're talking the difference between iPhones and Blackberries there. Intel was the Blackberry 20 years ago, cutting edge chips. Everybody needed them. What they were selling were chips to PC makers. Everybody needed a PC. The wind was at their back for decades. And now I think where the wind is blowing is not where their chips are most valued, right? It's in data centers. For a while, it was in crypto mining. Now they're saying it's in the AI world. And it's in those areas where AMD and NVIDIA will probably eat their lunch. And it comes at a time where I think you mentioned this before, Martha, or perhaps it was before we started recording. they're spending a lot of money building new foundries in the US. So at a time where they are seeing their sales really just fall off considerably, they're also having to conserve cash to invest in their physical plants. It's not a happy story for the Intel investor.
Yeah, I think you could make the case that they're maybe pivoting though, because it does look like they do have a strategy forward. So as you mentioned, the factory expansions, they're saying $100 billion over the coming years. And it looks like they, have partnered, there's a couple of opportunities. One last year where they signed a deal with Brookfield Asset Management on a $30 billion deal to help finance some of the factory construction. So, if you look at the NVIDIA reporting, it's pretty apparent that Intel has some work to do. NVIDIA saw significant bullish response to the company's AI vision. So it looks like, they were saying AI is at an inflection point, setting up for broad adoption, reaching into every industry. This is from the CEO of NVIDIA. Their AI-powered data centers business revenue jumped from $968 million in Q4 of 2019 to over $3.6 billion in the latest quarter. So they really had gone in on the data center side of the business and really reaped the benefits of that now. And the AI stuff, we haven't really spent a lot of time on the podcast talking about that. We probably should over the coming weeks and what the impacts could be to CRE. But it seems like, I agree with them. This AI concept, GPT, and some of these other AI assisted technologies are really at an inflection point in the marketplace.
When we're done here, I'm gonna use Chat GPT to check out what it says about Lonnie, Martha, and Haley here. I want to see, if it's glowing or half baked or negative. I want to know what I want to know what AI thinks about the three of you.
You'll say,
right?
who?
What exactly your sentiment score is.
Okay, so starting with Office, we've seen some of the challenges recently. Return to Office is getting some snags with Disney and Amazon employees lobbying against their return to work policies. So we saw with Disney about 2,300 employees petitioned their CEO against having to return to the office on a 4-day work week, Monday through Thursday, which was effective March 1st. And similarly, Amazon employees are saying, no thanks, don't want to come back 3 days a week starting May 1st.
Yeah, I don't know who has the leverage here. For a long time, the tech worker had the leverage. We couldn't find enough tech workers to fill the spots. Wages kept rising. People could define their own terms. But now we're seeing layoffs across the spectrum, and they've been sizable, 10,000 here, 15,000 there. I don't know how this plays out. I know how it would have played out a year ago. The employees would have gotten their way. At this point, do the employers have enough either gumption and or leverage to say, you don't want to come back, that's it? I don't really know. I guess time will tell. I'm a believer in collaboration. I think it's really, really important. I think the companies need this, and I do think young people need the face-to-face interaction with the gray hairs like me to come up with, how things really work in the world and to learn and so forth. So if it were my own kids and they said, I'm going to sign a petition, I would urge them not to. I would be get in there, learn, listen, do your job, try to figure things out.
Yeah, it seems like those might be the sign-up list for the next set of layoffs, in my opinion. Like 2,300 people petitioning against coming back to work 3 days a week. I don't have a lot of sympathy for those folks. And we've been doing a 3-day work week at TREP, and it's really a really nice happy medium where you get enough face-to-face time, but you still have some time at home, kind of the best of both worlds. So interesting to see such a, strong pushback here from both of these firms.
So starting out, we saw a big Office default announced this week, and it hit the news a couple days ago.
Yeah, we have so many Office stories today. I don't know how many we'll get through. We probably need a different vehicle beyond the podcast where it's like after pod or something like that, right? Like instead of watching, Jay Leno, you'd stick around and watch Conan O'Brien afterwards, right? For more comedy later. We need some other outlet because we can't possibly cover everything. But last night, this story was first reported by Bloomberg. Columbia Property Trust had defaulted on a $1.7 billion loan. The loan is backed by 7 offices across the U.S., a couple in New York, a couple in San Francisco, one in Boston, one in Jersey City. The loan went 30 days delinquent with the February remittance. The loan went into special servicing late last month. Bloomberg made quite a bit of hay out of this. So did The Real Deal. Columbia Property Trust, which is owned by PIMCO, is the sponsor of this property. I think that the news articles were painting a picture that this is the latest Brookfield. This is another situation where the property owner does not want the asset, is ready to give it back, and it's more sign of the office Armageddon, if you will. I have a different take on this. Twitter is the top tenant at this property. It has 7% of the GLA and 10% of the rent, or vice versa. It's one or the other that is 10 and one is 7. My theory here is that Twitter stopped paying, which we know is true. That's been reported in the New York office. They're not paying. Columbia is not getting income. And the only way you get relief for this is by going to the special servicer. And if I were to guess, they're going to the special servicer and saying, give us relief on some of the reserves that we have to finance and replenish every month until we get this Twitter thing settled. That's my own 2 cents. I could be dead wrong until Columbia comes out and tells us what they're thinking. We just speculate. But my thought is that they do like these buildings and they do want to keep them, but they need this Twitter thing to be resolved.
I actually agree with you. I think if you look a little bit behind the curtain here, all the loans were floating rate. Twitter stopped making payments. It's a perfect recipe to basically capitalize on, there were several other, property owners over the last couple of weeks that, had similar positions of not making payments or turning the keys back, or at least threatening to. The timing was right to basically do the same here, let it go to special servicing, try to restructure, try to get more favorable terms. So I agree with you. I don't think this is them saying they don't like this portfolio or they don't want the properties. I think it's basically taking advantage of an opportunity to try to get some relief. Now, whether or not that happens is a little bit speculative at this point, but my guess would be this gets everyone at the table and hopefully, allows them to get something done so that they can ensure keeping the portfolio. Maybe putting a little bit of pressure on Twitter and some others to try to come back to the table as well and start paying some of their rent.
Yeah, I have a much more concerning article this week in the office space than that one. To me, I think this is going to be resolved, and I could be wrong. Like I said, in 3 months, we could find out that Columbia is mailing back the keys and that's it, and they saw no value in the property. But the bigger problem for me was a story from Globe Street. Jack Rogers, who we referred to quite a bit on this podcast, he reported a story about M&T Bank, which said that the bank conducted stress tests and determined that 20% of the bank office portfolio loans in the office segment in their portfolio had failed a stress test. And what that meant was the loans were criticized in their books. And to me, that was an extraordinary number. I was shocked at how much office debt they had. I think they said the total portfolio of CRE loans for M&T is $46 billion, $5 billion is office, and 20% of that, so about $1 billion of it, is considered criticized. But if there's a canary in the coal mine, it was that for me.
This is kind of one of those stories that maybe doesn't get the headline capturing, following that we talked about on the previous story. But when you look at it, it's pretty daunting. So, they were looking at stressing based on debt service coverage ratios and 20% of the loans being criticized, significant. I think for us, it just starts to quantify how deep some of these office challenges could be across the broader market, because to your point, you probably wouldn't look at M&T as having the office exposure that they have. I would assume the same would be true for a lot of other lenders in the space. And I think we haven't even felt the full impacts of greatly reduced rents. A lot of these properties are still benefiting from contractual rents that are higher than in place. A lot of these are because tenants have downsized or right-sized. We're seeing the beginnings of this, but I think I agree with you. This is probably a canary in the coal mine type of moment, and I wouldn't be shocked if we see a few other lenders coming out over the coming weeks with similar type of situations.
A quick shameless plug for TREP services in right now is that among the top 50 U.S. banks, most of the banks with sizable CRE concentrations use our services for our data and or our default model to come up with these stress tests, to come up with how their loans will perform during various economic scenarios. So if you're a smaller bank out there with a sizable CRE concentration, and you want to know how this works and how this happens and what kind of data is available, what people do in building these, we certainly can have that conversation. It's something we've been doing really since Dodd-Frank came out several years ago, and it's an important part of our business. All right, very quickly running through some other real estate office headlines. This is where I get Lonnie's blood really pumping. From CNBC, Dropbox was hit with a $170 million loss based on the fact that its San Francisco office is sitting vacant. Companies will have to take impairment charges for unused rents. We've seen this before. I'm not sure if 175 million is the biggest we've seen, but that is certainly quite enormous. In New York, a big Madison Avenue office was extended. Cranes New York pointed out that the $103 million 515 Madison Avenue loan was extended. The property is a 300,000 square foot Midtown Manhattan property at 53rd Street. The loan backs a third of the collateral behind a 2013 deal. I think we'll see a lot more of this as office continues to struggle. On the other side of that, in a similar vein, Wells Fargo Charlotte offices. This is the office where Wells Fargo announced last month it will be vacating its one Wells Fargo Center and two Wells Fargo Center in Charlotte. Those properties back $160 million in debt. Wells Fargo once had about 700,000 square feet there. They dropped to 300,000 square feet. Recently, they said they're even giving up that 300,000 square feet. The borrowers behind the loan have now requested a maturity extension. The loan matures later this year, and it may go down the path of that big Madison Avenue loan that we just talked about a moment ago. I'll give two more happy stories before we move on to a different property type. In San Diego, Broadcom has signed a 5-year lease renewal at the Discovery Corporate Center. The property is 230,000 square feet of Class A office space. The story comes from Simona Tudos of Commercial Property Executive, and Broadcom has about 90,000 square feet there. In a similar type of story, KBS has renewed in Minneapolis. The firm has 50,000 square feet on American Boulevard, 3,500 and 3,600 American Boulevard, part of the Northland Center. So we're happy to report that. And then I do have one more. In Draper, Utah, Gardner Company has signed a 135,000 square foot lease through Colliers. Colliers was the broker there, and the property is at 42 Futures Way. So even though we have a lot of negative stories out there, there were some green shoots in terms of leasing activity, and I'm very happy to report that.
And moving on to retail, we have a long list of retail stories. And I think we put out a news flash just this morning on a Walmart update.
Yes, here, this is one of those things that sometimes it takes a little scratching beneath the surface, but Walmart announced over the last month, they announced they're going to close 8 stores. Today, it was 2 in Portland. One of those stores is not collateral for a CMBS loan, but it is shadow collateral. It is the anchor that draws other people in to the nearby Ross Dress for Less or the movie theater that's across the street there. The property backs an $18 million CMBX 8 loan, and that loan now becomes more under scrutiny because Walmart will no longer be there to drag in the foot traffic. It's one of those things that it's a after effect of losing an anchor tenant that's not part of your collateral. Sometimes you don't know that's a story until you start looking at the surrounding area.
And we have a number of other stories. Last week, we cut out our normal retail segment. So some of the stories are actually content that we were going to cover last week, in addition to the news stories we have for this week. So let's get through those.
Yeah, very quickly. In Baltimore, Maryland, the value of the White Marsh Mall has been cut. This is a 700,000 square foot mall that backs $190 million CMBS loan. The value at one point was $300 million. In 2021, it was lowered to $124 million. And this month, the value was lowered again to only $100 million. So a lot of negative equity in that particular asset. In New York, the Crossgates Mall, that backs $245 million in CMBS debt. The collateral is a 1.3 million square foot office super regional mall in Albany, New York. That loan is now back to special servicing. It is one of the biggest assets, it may be the biggest asset at this point, backing CMBX 6. 3 different deals that are part of CMBX 6 have portions of the Crossgate Mall loan backing them. A potential glimmer of hope in New Jersey, the $300 million Bridgewood Commons loan missed its balloon date in November. The loan has been with special servicer. The value was said to be well below the loan balance. The owner had no interest in supporting the loan any longer, calling it a victim of obsolescence. Recent special servicer notes said that there's a potential buyer with a loan assumption and modification possible. So a little bit of glimmer of hope there.
That's Bridgewater. I think you said Bridgewood, but I thought you meant glimmer of hope, meaning me.
Martha is our glimmer of hope in New Jersey. Yes, every week, New Jersey is just that much better off.
Appreciate it.
Yes, there we go. 2 more very quickly. In New York, a couple of months ago, we reported that a big loan, $125 million loan backed by street level retail on the Upper West Side had missed its balloon date, gone to special servicing, lost its Best Buy as a tenant, and later became delinquent. The loan is also part of CMBX 6. The story here is that the value of the property was absolutely destroyed. The property was valued at $195 million in 2012. This month, the value was lowered to just $79 million. This is a smallish property that is now close to $50 million in negative equity. And then lastly, the town center at Cobb, which was a REO asset also backing CMBX 6. This mall was resolved with a bigger than expected loss.
Yeah, so Manish, you just covered a whole lot there, all related to these, larger regional mall type of retail properties. And I'll tell you, it's interesting when you start looking at these deals that are 2012, 2013 vintage and past their maturity dates. I wouldn't be shocked if we're still talking about some of these properties for the next 2 or 3 years. It seems like, as you refer to them in purgatory, that's where a lot of them just hang out. It's kind of where they are. We talk about appraisal reductions, we talk about assumptions, we talk about modifications, but usually they're just kind of hanging out there in some form or fashion, similar to what they were the previous year. Occupancy maybe uptick a little bit or downtick some, collateral value being cut significantly. So in the last 2 segments with office and some of the negative news there in retail, I'm hoping that we can find some green shoots for the rest of the property sectors today.
So let me ask you this before we move on to another property type. Incredible resilience, incredible loyalty to their properties, tons of leaning in by retail landlords, retail owners since 2017. These guys, Pyramid, that owns the mall, the Palisades and other malls, the guys that own the Crossgates, incredible amounts of negative equity. CBL, the same thing. Washington Prime, same thing. Really fighting for these assets. What is the likelihood that the office owner has that amount of stick-to-itiveness? What do you think?
Yeah, I think we're starting to see that they don't, based on the headlines that we've read about the last couple of weeks. And it'll be interesting to see. I think the property types are just so different in terms of scale in the marketplace. So, in terms of regional, super regional malls, those are fairly limited in terms of number of properties and across the different geographies, whereas office, there's a lot more office properties. It's a much more competitive landscape. If you're somebody that's long-term bullish, even though maybe the property's down right now, it's going to be hard to make that case in office where you have other Class A properties being built right next door that are competing directly for the same tenants that you are. In the mall space, you have a couple of really large players that kind of dominate the space. We've seen Simon, actually take ownership interest or an equity position in some of their tenants. Like, it's a little bit different dynamic there than what I think we have in the office space. So, while we made the correlation between office and the mall space from a financing perspective and from a distress perspective, and I think those are valid, I don't think you're going to see the same type of vigor from the ownership side on these office properties once they decide they're just not viable. Functional obsolescence for office is a very real thing. and the lack of barrier to entry for some of these new Class A participants to come into the market just reinforces that and accelerates their demise.
Well, I want to give Lonnie some red meat for the green shoot people out there, people that want more green shoots. It was a lot of crabgrass in the retail space. I did give some green shoots in the office space. So I owe you one on the retail side, and I'll give it to you right now. This is from Shopping Center Business. They are reporting that Bedrock, who is Dan Gilbert's company, he owns about half of downtown Detroit. He owns Rocket Mortgage. He owns the Cleveland Cavaliers. They have revealed plans for a development that will be known as Cadillac Square. It will be a 1.5 million square foot mixed use campus in downtown Detroit. And for that city, Dan Gilbert is just the gift that just keeps giving, right? That was a city left for dead 15 years ago. And it just goes to show what one man can do when he wants to take a city on his back and help it redevelop. I can't think of another place in America where one guy has made more difference to a city than Dan Gilbert in Detroit.
Are you giving a quiet shout out to Emily right there?
There you go.
So let's move on to hotel. We have a couple stories that we'd like to cover there.
Yeah, the big one, this is about a week old, but it was really noteworthy for us. This was not a green shoot at all. This is with regard to the PFHP portfolio. It is a portfolio that backs a 2017 single borrower deal. The collateral is made up of 20 hotels, many of the properties located in the upper Midwest, some in the Southwest. The loan was originally slated to mature in 2019. 3 12-month extension options pushed the maturity to late last year. The balloon date was missed, and the headline is that the borrower has, quote unquote, refused modification proposals, and negotiations on potential deed in lieu transactions are ongoing. Hotel has been incredibly resilient, as we've reported for a long time. Recovery proceeds have been much higher than expected. Cures have been plentiful. Property sales volumes and metrics in terms of dollar amount per square foot have improved steadily over the last year. This is a rare bump in the road for that market, that an owner of a big portfolio like this is looking to give back the keys on so many properties. Hopefully this is a rarity.
Yeah, and if you look at that portfolio, it looks like debt service coverage for this portfolio has actually been really strong for 21 and 22, last 12 months. Like as of March of 22, loan posted DSCR of 2.11x and occupancy of about 66%, which is right in line with what we're seeing in terms of that strong rebound you mentioned, Manus. So another hotel story here, Manus, maybe 11th hour reprieve for Brooklyn Hotel. According to Commercial Observer, Chetrick Group may have a deal in place to avoid foreclosure on the Hotel Bossert in Brooklyn. The piece from the Commercial Observer notes that Ian Schrager and Ed Sheets potentially in line to come together with Chetrick on the hotel. The duo is looking to, trying to raise about 25 or 30 million in fresh equity to rebrand the property as a public hotel. This is a 280 key hotel, backs 112 million Hotel Bossert loan. It's part of a 2019 deal. Servicer data on this property shows last payment on the loan was in September of 21, and that the loan had a maturity date of December of 21. As part of the previous securitization, there were 3 12-month extension options that could have pushed maturity to 2024, but those extension options were not exercised. At origination, it had a value of about 178 million back in 2019. And since then, it's had several updates to the valuation, with the lowest value being reported in about 117 million as of 2020. It does look like the property stabilized a little bit, with the most recent valuation coming in at about 130 million. So more to come on this, but maybe some good news for this hotel in the Brooklyn market.
And a programming note. On Monday, February 27th at 3 p.m., TREP's own Lonnie Henry, yep, that's the one, and our research director, Stephen Bushbaum, will host a Market Pulse webinar, and we get some really good interest. It's available to anybody who's interested. Reach out to us if you want to join. We'll have included in that discussion an office lease expiration and loan maturities discussion with Allie Bauman from CompStack, and that particular report got a lot of interest. So it's worthwhile listening in. They'll cover other things that are happening in the macro market. Shout outs. Jim B, I'm a relatively new listener and is loving it so far. Eileen G, weekly listener, love the Bed Bath & Beyond commentary from Manus. Sean M, interested in our East Palestine analysis. Owen L, who is a very enterprising and resourceful student, reached out to us from Cal Poly and wanted some data for his university paper. He's a big fan of the podcast, so thank you. Hunter on Twitter, this is interesting, who's watching Tiger Woods at Riviera today while listening to the podcast, episode 180 in the background. So what an interesting voiceover that's got to be for watching. Dikey H, real estate master student, longtime fan. Brett K, Mark R, also, and a number of people that were interested in our office report. David, Ron, Chris. Mark E said our weighty pod last week, having to pause and rewind often. Great content, ideas, and insights. A lot was packed in there. A bunch of folks that were interested in our education scholarship, Max, Corey, Chris, Keith. And a question from Lynn M. JT on Twitter replied to who's listening and said me every single week and added to let me know that I guess I'm doing a pretty good job. And as for Manus, I'm not sure he's on Twitter. That dude is all right. Obviously a quote.
See, I'd like to see this guy who was on the golf course put us on speaker right when Tiger's on his backswing and see what kind of reaction we get out of Tiger. See how angry we can make him, when he's trying to tee off on the fourth hole at some place in Arizona or California. And
we're going to close with a PSA. Hines is looking for Elvis Francois, the man who survived for more than 20 days at sea in a sailboat with no food other than ketchup, seasoning cubes, and garlic powder. He lives in Dominica, obviously in the Caribbean. If you know him, let him know that Hines wants to help him buy a boat. So let's do what we can to find the ketchup guy.
I'm thinking if I'm out to sea for 20 days, what is the one thing that I would say could get me through? I'm going to go with the Almond Joy, right? You got a little bit of protein there. The Almond Joy is pretty moist, so you feel like you're getting a little bit of water in there, and you get your carbs. You get your chocolate, and it's almost like a full meal in 2 small bars in one wrapper.
I'd have to agree. I thought you were going to say Starbucks with some olive oil in it. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trep.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.